the Compass. With me, as always, is Sam Pelez, President, CEO, and CIO of Olive Resource Capital. And my name is Derek McPherson. I'm the Executive Chairman of Olive. Today, we're going to go, we talked a little bit recently about markets and what's going on there. Today, we're going to deviate a bit, talk about something that's topical in the markets as we speak, but is, I think, something that is of interest to us and something that an area that we like to invest in, which is royalty companies. I guess the reason it's topical this morning is that we saw earlier this week, we saw Origin Royalties get taken out. Sort of get taken out. They effectively, their tier one royalty that they had on the very impressive Silicon deposit was, basically acquired by Triple Flag, and they're creating a spin-co out of it. And I think the reason that we like it, or the reason it's topical to us, is that it's a tier one royalty. And tier one, there aren't that many out there that aren't in major companies, and so it's certainly something that's worth talking about.
Yeah, no, it's big news, very interesting news. Origin is not far from home for us as an investment and also as a company. We know the people there. And number one, congratulations to Origin and its shareholders, because it's a pretty impressive takeout. Great value, in my view. And it's, funny to think we were there. We were buying this at 45 cents when Altius was buying it publicly in the market at the same price. I want to say that was 2 years ago. It's not that long ago. And great value realization here for everyone involved. Even for Altius, I think, with their stake in the company. But I think, correct me if I'm wrong, but I think we have to go back to the Great Bear royalty sale for the last reference point of a royalty of this caliber that traded.
Yeah, maybe before we jump right into the nitty gritty, Sam, maybe we should just explain kind of royalty companies are pretty unique. There's only probably a dozen of them out there. Maybe more. They seem to create new ones every day because of the business model. But maybe we should just give 30 seconds on royalty cos and what they are and why they're ridiculous valuations that they trade at, and relative to the rest of the market, not relative to each other,
right? And
why they can be attractive investments.
Yeah, well, historically, the royalty model comes from the oil and gas industry, but it's been applied very successfully to our space, or the mining space as well, predominantly in gold, because the return itself is very easy to calculate. There's not a lot of discounts and penalties charged by the downstream portion of the buyer. So let's start with the concept. The concept is an individual or a corporation has a right to a percentage of the revenue, and that's typically in gold described as the net smelter return. So effectively, what the payability of the product the company sells. In most cases, that's very close to 100%. In other cases, could be in the 90 percentile, but still pretty high realization. And what the royalty companies typically do is, they acquire it by vending the project to the developer, or number two, they purchase it from the developer of the project, and they have essentially a right for the life of mine to a percentage of all the revenues. In most cases, what we see typically is either 1% or 2%. Historically, saddling a deposit with more than a couple percentage points makes it very hard to develop, because on top of that, you typically have government royalties and other royalties that are attributable. But the concept is simple in that regard. What's interesting from a market's perspective is that you have no exposure to the cost portions or the risk that's attributable to cost overruns and margin compression that you may see as a result of that. Your sole exposure is to the commodity price and naturally to the production success of the development project. You also get exposure to any exploration upside. Most royalty agreements contemplate new discoveries within an area of interest around the deposit or at depth are also included in the royalty. And in a sense, when a project goes over the hurdle and becomes a full operating project, you're literally just sitting in your office waiting for the royalty check to arrive every month. So from that regard, it's you get exposure to the commodity with substantially less risk.
Yeah, royalty companies are amazing, right? Like I was just looking at Franco Nevada, right? 46 billion Canadian market cap on Franco Nevada.
Yeah.
It's and has 30 employees or 40 employees. That's it, right? And that's that. You literally once you have you do your work on the due diligence side, you get your 2% NSR. When I was an analyst or research associate, actually, we covered Franco Nevada, and it was like every 2 or 3 quarters they would just like, oh, we have this new 10% or 2% NSR that's going to start cash flowing at some asset in wherever in a quarter, right? And you'd model it in, and all of a sudden they'd have another $1 million in revenue instantly like that. So the royalty portfolios like that are very hard to build. It takes years and years and years. Franco Nevada has been doing it for a very long time. But I think you keyed on, they are lower risk commodity. They provide lower risk commodity exposure, right? Gold royalty companies in particular. If gold is an inflation hedge, you're a gold company, its costs go up with inflation, right? So your margins tend to, I like to joke that if you look back over the history of time, probably the margin of mining an ounce of gold is exactly the same for the last 5,000 years. And so consequently, it expands and contracts at different times. But with a royalty company, that margin is always constant, right? You have this very low overhead to manage the business, and you have this revenue. And as the gold price goes up, your revenue increases. And it's a low risk way to get exposure. If you had bought Franco Nevada at the beginning of the year, you'd be up 43%.
Yeah.
Right. That's, and if you think about the gold price move, et cetera, and so, for investors getting into, for investors looking for mining exposure, lower risk mining exposure, commodity exposure, royalty companies are very attractive, and they attract a lot of generalist investors as well. The Francos, the Royals, those companies.
Yeah, but and like I said, like the concept originally comes from oil and gas. So the oil and gas market is far deeper in terms of value and number of opportunities than the gold market. So when a generalist investor comes over for the first time to the gold market, like you said, typically the first purchase is Franco Nevada.
Yeah.
Or the first look is Franco Nevada and the royalty space.
Yeah.
Because ultimately they're chasing gold exposure, not exposure to individual projects.
Right.
Like we do. Like we're specialty fund managers in the gold space. They look for specific projects where they think the value is not well represented in the market. But for the generalist investor, it's all about the beta to gold.
Yeah.
Which these companies do deliver, in fact, no question.
But as you just pointed out, we're a specialist fund in the mining space or resource space, and so we're not looking for beta per se that you get with a Franco Nevada or something like that. We're looking for alpha, and I think interesting. One of the first opportunities that we identified when we first took over Olive was Great Bear Royalties. We're pretty public about our position there, and I guess this is the circle back to Great Bear and Origin, and then another company that we own that we think has probably similar trajectory now, and we'll talk about that at the end. But tier 1 royalties, so royalties on large scale assets in good jurisdictions, typically are not held by small royalty companies, right? Mm-hmm. These are the ones that build things like Franco Nevada. And if you look at like Franco Nevada has royalties on Macassa, Fosterville, Detour, Goldstrike. And Goldstrike was the company that was the asset that built Bear. So those types of royalties that cash flow $15 to $20 million a year are very rarely in small public companies. Right. With a couple of exceptions. So when the creation of Great Bear Royalties, and I think this was smart on the part of Great Bear, is they effectively created the 2% NSR that became Great Bear Royalties. They spun it out of Great Bear, and effectively giving the shareholders a chance to win twice. But when we looked at it, we looked at Great Bear and we looked at the potential there, and we thought Great Bear at that time, Great Bear was I don't know if Great Bear was fairly valued then. I think it was still discount, but the valuation gap from what we saw at the potential of Great Bear to Great Bear Royalties was significant. And so here's a tier 1 royalty trading in a public vehicle, a clean public vehicle at that point, that we thought was a great opportunity.
And I think what attracted us the most was the scarcity value, which is the same value that was realized here in Origin. We'll talk about how that progressed over the last 2 years. But with Great Bear, it was very clear to us that this was a tier one asset, that it was going to be aggressively chased by major producers, and that obviously this royalty will be valuable considering that, if a large purchaser bought Great Bear, was naturally to develop it and build it, which is obviously what Kinross is doing right now. And I guess the scarcity element that I mentioned was always present here in Origin. When we started looking at it, the AngloGold had started to round out the missing pieces of the whole Silicon Merlin, all of that camp, but they had not put out any meaningful resource on it. So it was all about the speculation of how big a resource could be. But considering the footprint and considering let's say like how aggressive Anglo was to roll up all of the land packages in that area, the expectation was that the resource could be substantial. I think initially, it's only 2 years, but this thing started blowing out very quickly. But I think we were thinking about a 5 million ounce deposit. And at the time, we thought it was certainly worth more than the 45 cents a share that Origin was trading at. Altius, which for those that are not well informed in this space, is also a royalty holder on almost the same, very similar land package, slightly larger royalty. But the biggest difference is that Altius royalty agreement had information rights. So Altius knew what Anglo was doing, whereas my understanding is that Origin didn't. And Altius was aggressively buying this Origin stock on the market in the 38 cent to maybe 50 cent range. And that was a key element for us as well. And we were invested in Origin for some time, from that 45 cent range to the, call it dollar, I think I want to say $1.13 area. So we had a really nice pass on this. And then what happened was Anglo kept just drilling and expanding this resource to the point where I want to say today the last resource between Silicon and Merlin is north of 16 million ounces. And this is in Nevada. AngloGold Ashanti is now a U.S.-based company with a U.S. main listing, and they want to make this U.S. project their flagship. So you got the exposure to this incredible just development scenario from a position of no risk. It's no wonder that the stock has kept the Origin stock kept going as the results kept trickling in. And now you're sitting on 16 million ounces, and your partner is Anglo. So I think it was no surprise for market participants that this announcement came through. I think it was a matter of when, not if, it was going to be taken out.
And credit to Origin's management team. They were able to extract maximum value for this royalty. Quick math is, the rough numbers, and I think, the rough numbers on Silicon Merlin is that it's going to produce probably 500,000 ounces a year for nearly an eternity, based on the size of the resource. And at that scale, and it's a 1% NSR on that 16 million ounces. And so, roughly trades, if you think about it in terms of, sort of $3,000 gold, to keep the number simple, they bought it for about 50, Triple Flag is buying it for 15 times revenue. Which, if you look at sort of peer comps, that's where the major royalty players trade, right? So if you want to think about it from that perspective, I think that's premium assets deserve premium prices, right? There's a scarcity value in that. And I think this is good. I think it went for more than we expected it to go for, in full transparency. But I think that's if you're trying to build a royalty company, generally speaking, you need one of these assets.
And I mean, for transparency, we participated in the rally. We got off the bus at a certain point to invest in a different royalty company, which is also doing very well. So no harm nor foul, but we're very happy to have been part of this, and also very happy that good people doing good things. And I know a lot of people who are substantial shareholders of Origin have done very well, because this is this is a case study of how proper research and following a story and understanding the details and all the moving parts paid off over time.
Well, and it's the other thing with Origin and the challenge. Part of our challenge with Origin was that it was never very liquid, and so
Yeah.
so it was always very difficult to build a position and exit a position. So you got to be careful with that. And we're not that big a fund, and so that's always something to be cognizant of. So I guess obviously we've talked a lot about these tier one royalties and their scarcity value and why I think they're interesting. But I think maybe let's take a step back. How do we, I guess, evaluate royalty companies? Right, we get shown things all the time. Sam, you have a pretty good quick back of the envelope method to sort of evaluate these things. Maybe just talk a little bit about when we see a company and it's generating revenue. And I think this is before we look at a royalty and we evaluate what we think it's worth. I think one key point here though is that a royalty that isn't producing cash flow or doesn't have a clear path to production is worth zero. And that's how it's valued by the market. Unfortunately, and I think that's a key point here. What happens is that inevitably what happens is all these royalty companies get created and they have one cash flowing royalty or two cash flowing royalties and 25 non-producing royalties that aren't on a path to production, right? They have 2% on some moose pasture in Manitoba, right? That royalty is worth zero. So I think, but then so let's look at we look at it, we're going to write off all those non-cash flowing royalties. They're a bonus, right? If that thing advances and the company moves, and it could. But what we're really focused on is here are the cash flowing royalties. So maybe talk a little bit about how we evaluate them, because tier one is different, right? You can put a premium multiple on it, but just general cash flowing royalties.
Yeah. So you only ascribe value to cash flowing royalties, obviously, because you can use the cash flow as a metric, but also, like you said, to development stage projects that have a realistic path to development, like the case of Origin. AngloGold's there, very aggressive. I don't remember the number. I think there were 20 rigs turning at one time on the project. That level of commitment on expenditure tells you that this project is moving ahead fast. So you can build a valuation for this. So the way we've looked at this is you can look at the revenue multiple. So if you expect Silicon to produce 500,000 ounces a year and they have a 1% NSR, that's 5,000 ounces of value attributable to Origin in this case, times $3,000 gold, that's $50 million a year. Now, royalty companies trade somewhere between 10 and 20, 20 being Franco-Nevada, the unattainable valuation that nobody else has been able to get. But 15 million a year times 10 is 150 million US, which is, pretty decent valuation. The market has ascribed Triple Flag has ascribed a greater value to this. They may be thinking that the production is going to be greater. They may be thinking that they want the exposure to the long life asset. Only they know what they're thinking, but it sold for about 15, 16 times revenue on that metric.
16 times revenue, yeah.
Which is on the higher end of the transaction comparables. The other way to look at it is to look at the resource and build a resource-based model. So 16 million ounces times $3,000 gold, the in-situ value of times 1% in this case. I don't have the calculator in front of me, but that's the way we've valued some of the royalties in the past. And depending on the quality of the project and the jurisdiction, etc., you get sometimes something between 50 to 80% of that in-situ value. Closer to 50 typically, but also in some cases you get more than that, especially when there's significant exploration upside, which I think there is here. But after having 16 million ounces, that's year 25 in the future, so not something that kind of fits a cash flow model. So with that in mind, based on our models, this was a nice premium takeover. So kudos to the Origin team for getting this done. And we've used that to value other projects. And maybe this is a good time to start talking about other royalty companies that are out there. One company that we have an investment in is called Vox Royalties. Pretty smart group. They've done some very aggressive acquisitions in royalty acquisitions in Australia at very nice prices, meaning very low prices for the value that they're acquiring. I recall 2 years ago, they bought a royalty on a project owned by Northern Star. For the Canadian audience, Northern Star is the largest gold producer in Australia and as a tier one company gets. And it's a 4% NSR on a small project, but once you put it through our churner at the time, we ascribed $100 million just to this royalty alone, and the market cap of the company at the time was, I want to say, $100 million. So that gives us a lot of confidence to increase our holding, and that company has performed really well over the last year and a half. They've continued to add other assets to the portfolio, and they have a pretty nice growth path ahead of them. And by growth path, we mean royalties coming into production and the revenue kicking in from all these projects.
What happens with a lot of, and I think that's a good say, what happens with a lot of these royalty companies, especially newer ones, is they end up with kind of a hockey stick revenue curve as you look ahead, right? They go from, making a little bit of money, and then all of a sudden they have this asset that they're able to get cheap because it was in development, and it goes, and there's a massive step change in their revenue, and you keep getting that step change. When you have that hockey stick moment in revenue, that's when these things you tend to re-rate in particular. And we're always very hesitant on, what we want to see in royalty companies is a lot of the NAV ascribed to early stage royalty companies producing assets versus non-producing assets. I think that's a key element for us. And in Vox's case, they've gone through this a lot of this hockey stick curve already, and still have growth and growth ahead of them.
Yeah, no, what I missed the point was we ascribed $100 million US to this royalty. The company was trading $100 million US and still has north of $10 million a year in revenue. So you're ascribing the same multiple. Yeah. It's not Silicon and Merlin, so maybe the 16 times revenue multiple is not what we do here. But if you give them a 12 X revenue multiple, then that should be 120 million US. That was, it was already below market by itself before this round of acquisitions that it did 2 years ago, which for us more than doubled the value of the company. So we invested, and this stock has pretty much doubled. So also on the gold price performance, but we still think it's a pretty solid royalty company to be involved with.
And then I guess the I guess, for lack of a better description, I think probably what is now our favorite royalty investment, and I think the one that we think has the most upside, simply because it's been hiding a tier one asset, a tier one royalty in it, is Sailfish Royalty, ticker is Fish. Looking at that company, they do generate they do have a producing royalty in Nicaragua. Obviously, it's related. It's in the Wexford group of companies, so it is a related party to, or an arm's length related party to Mako, which is a producer. But one of the assets that they acquired a number of years ago was a 2 to 3% NSR, and I say 2 to 3 because it depends on where it is on the property package, on a project called Spring Valley in Nevada. And Spring Valley was owned by a private equity firm here in Toronto, and really hadn't really seen the light of day. And so even though they had this royalty on this really impressive asset, potential asset, there was no public information out there about the asset. So the market never really ascribed any value to the royalty. And so we own, and full disclosure, we're shareholders of Fish. We have some convertible debentures, we have shares. And we're in at a lower price than where it is now. But the opportunity that we're seeing is that what's happened over the last year or so, and why the stock's performed very well, is that information has started to come out about the project. So the private equity firm that owned it, they filed for permits, right? So all of a sudden you had an idea what the production schedule is going to look like and what it could be, and so that was positive. Now they've wrapped up a private company around it, and they're running a sales process, a formal sales process for it. And so all of a sudden you've got so we hear. there's a sales process going on. So this asset all of a sudden is going to come and get public attention, and people will know what it is and how big it is and what the opportunity is. And that's going to create a re-rate. And so what we know about the feasibility study is it's going to produce about 300,000 ounces a year. If you assume that, so that 2 to 3% NSR, and we stick our 15 times revenue multiple on it, which is, is what this just traded for. What Silicon Merlin just traded for. This asset is worth 200 million US on its own.
Right.
Roughly.
And this is a company that's worth 120 Canadian on the market.
Right.
Right.
So we think, we've been building a position in fish. It is also somewhat illiquid. So, but we think that there is an opportunity here for this thing to materially re-rate, and potentially maybe even a Origin style deal where someone wants just that exposure to the Spring Valley, to Spring Valley. So, it's one that I think we're, needless to say, we're excited about.
I think one of the greatest parts of this royalty space is the informational advantage that you can get, because it gets convoluted. The information is released by third parties that are not directly the company. So, that was the case with Origin as well. Everybody was, well, not everybody, but the well-informed people were watching the AngloGold results rather than the Origin results to make decisions on the stock. Here's the same situation where, even though the royalty sits within Sailfish, the disclosure is coming from public disclosure in the state of Nevada in most cases, rather than from press releases from the interested company. And that's allowed us to get involved early and track it and follow it. And obviously, this project was, the technical studies, if I remember correctly, were done at $1,800 gold, like most projects that are in the market right now. But at over $3,000 gold in a place like Nevada, you can assume that there's going to be great interest for this project right now, if it indeed is up for sale, like what the rumor is. The other benefit of this company is it's very tightly held. The largest shareholder, which is Wexford, and the management and board together own something like 70% of the shares. That's undesirable when you're trying to build a position, but once you have a position, it's a very desirable situation, because obviously, if indeed this project takes off, any potential sale will have to be, friendly, which means it has to be at a pretty nice valuation.
And the same thing happened with Origin, right? Because you had large insider positions, but also you had Altius and a couple of other funds that had big positions. And so, the joke would be, effectively had the adults in the room, right? So the company couldn't, wasn't going to hold out too long. They were going to take a bid, but they could hold out long enough to take a real investment, I guess, if you will, right? They could, for lack of a better description. So I think that's there's a, I didn't explain that very well. So there isn't, I guess, when you have large shareholders like Wexford or like Altius in the case of Origin, is that they're not going to jump at the first bid, right? They're not going to take too little in the market. At the same time, they're investors, and so they're also not going to hold out too long and miss the opportunity. And in M&A, and we, it's an episode in itself. In M&A, those are the two extremes. You sell too soon, or you hold out too long. Those are the two things that happen.
Or the board and management get entrenched because they don't stand to make too much out of the sale.
Right.
But in this cases where there's such high insider ownership, the alignment is clear, because the sale will represent maybe decades of whatever you can make as an officer of a company like this for the insiders. So there's no conflict of interest from that regard.
Yeah. So I think with that, and I think that's a pretty good. I think that's a wrap on royalties, I guess, for lack of a better description. So thank you very much for listening. Let us know what you think about. Fish and our investment there, or other royalty companies. We're always interested to hear.